Welcome to At Home with Beach Realty. I'm your host, Tracy Pavone, and today we visit with Scott Beach of Beach Realty and Ryan Heineman of the Heineman Mortgage Team to discuss the top questions home buyers ask lenders. Let's join Scott and Ryan.
Hi, I'm Scott and I'm here with Ryan today.
Thank you for having me, Scott.
Well, great. Well, thank you for your time today, Ryan. What I have is a series of questions that many of my clients have asked me about lending, and I always like to refer them to the professional. So how about if we go over some of these questions so you can help educate our audience?
All right, I'll see how I do.
Well, the first question that I commonly get is, how long does somebody need to be employed to qualify for a loan?
Yeah, that's a good question because there's kind of the standard answer that everybody says in 2 years, okay? But actually, programs such as FHA and other programs for first-time home buyers that realize that there's other instances and factors that can actually be less than that. A good example of that is you have a college student who is just graduating and starting a new job. Their actual transcripts and their time in university can be utilized as part of that job history. Okay, so if there's been any type of training or anything like that, that could also go into that factor. So a lot of times it depends more upon the exact scenario, and it could be as little as having started the job literally just before we go to closing because of some type of historical data that aligns and makes sense with the progression to that job.
Well, that's great to know. So another very popular question is there a minimum credit score required to qualify?
This is also another one where you have, banks have set what they call guideline overlays, okay? And so a lot of institutions have, and that's why you may hear from one institution to the other. We can go down to 600, we can go to 580, we can go to 640. And those are because those individual institutions have set those guidelines, okay? So that can vary from lender to lender. But as far as the agencies go, the main determination is there's not really specific credit scores as much as there are automated decision engines that support FHA, VA, Fannie Mae, and Freddie Mac, your major agencies, and even USDA is another one. And so as long as you run that scenario and you're receiving an approved eligible, and the institution that you work for doesn't have any other overlaying guidelines about credit score, and you receive an approval, then essentially you're good to go with that credit score.
Great information. So the next question is certainly very relevant in today's market. What happens if the house doesn't appraise for the sales price of the purchase contract?
Yeah, we're running into that, of course, and those discussions are going on. We're even now seeing it in contracts where we're seeing additional addendums for appraisal gap allowance and how much a client going into the transaction is willing to allow for an appraisal differentiation from the contract price. So what happens is a couple of things. If you have someone that is putting down the minimum down payment, they're going to be most impacted by something of that nature, okay? So what you would need to do is go over that with them if you think there's that potential, because a minimum down payment type of client, that could almost, if they don't have the additional funds to do it, that could essentially hinder the entire transaction, okay? For other people, it's a matter of now that the loan to value would be calculated off the lesser of the two between the contract price and the appraised value. Now it may be a matter of them either putting down more money to keep the same financing secured, or it may be a matter of them actually increasing their loan amount because maybe they can do that due to the scenario that they have. So there's a couple different factors that come into there, but ultimately it does not mean you cannot provide the financing.
Now, am I correct that that addendum you spoke of where the buyer's going to cover the difference is not really allowed to be used for an FHA or a VA loan?
That's incorrect. We can still utilize those even in those instances as long as it's outlined in there and that the client is able to do it. The main thing is does the client have the capability to do it? We see that happen on, VA loans is a common one because a lot of times people are going for 100% financing.
Right.
Right? And so if you missed there and they were going for 100% financing, you have something to address.
Right.
Okay.
Well, Ryan, can you tell us what the difference is for the tax rates between a resident and a non-resident of South Carolina?
Sure, certainly. In fact, this is something that some clients do get kind of stumped on because they may be looking to buy a second home here, and they say, "What's the taxes?" And I give them the figure, and they say, "I always heard that South Carolina, the taxes are so low there." I say, "Well, there is quite a large difference between the primary tax rate or resident tax rate versus the second home investment or non-resident." Okay, and it's a formula. Okay, so it's primary residence is calculated at 4%, and then there's a millage rate, which generally around here calculates at 0.08. Then you have a 6% tax rate for the second home. But what it equates to overall is somewhere almost very close to the second home tax rate is almost 5 times higher than, and a lot of people do not realize that. And we, the mortgage and lenders in general, and everyone in the industry, also try to explain to people that we are not the authority on this. Okay, we can set it up in certain ways, but ultimately the authority in this area would be Horry County, Georgetown County, wherever you are, and they're the ones that will make the decision, and you have to apply with them after you close on your home to make sure. And if you don't make that application as a residence, you'll get taxed as a non-resident. So it's something definitely you want to do to take advantage of that savings should you actually be qualified to receive that residence tax rate.
So that being said, what happens if there's a couple who is purchasing a home and one of them is still working and wants to maintain residency in the state they're moving from? Is the other half of the couple able to become a resident in South Carolina, and would that apply? Would that make them eligible for the lower tax rate?
Right. Once again, the lender is not the authority. Also, I'm not a CPA. But to answer your question, it is common practice that you can have what we use commonly in our industry as a trailing spouse. Okay. So, and as long as the one person is meeting the primary residence qualifier, which is living here full time, like we talked about earlier, as well as putting that application. It generally comes with registering a vehicle, having a South Carolina driver's license, all utilities in their name. The other, what would be almost considered a non-occupying co-applicant, can go back and forth until maybe such time that they retire and then they come, but they could go ahead and still take advantage of the primary. What others, personal situations where they need to make sure that they're talking to all of their folks, financial advisors, CPAs, and everybody involved in their situation before they do that, to make sure there's no adverse impact for them as it relates to the other home that they may still own, and so on and so forth. That's not for us to really get into, but in theory, yes.
Great. So with the market being such a strong seller's market right now, is it possible for somebody to purchase a home with cash, since that will make their offer a lot more attractive, and then after it closed, be able to finance the home on a separate transaction?
Absolutely. We're doing this more in the competitive market environment. We call that delayed purchase financing. Okay. And so essentially, someone who does have that capability with the cash, they may choose to go ahead and utilize that money up front to be able to be most competitive on their offer, secure the home. We could already be working on the loan even leading into that, because a lot of people sometimes will take it out of an account where there may be a penalty after so many 90 days or something. Right. And so we've already got our transaction in the works so that after they close on it, the main key there is they have to show us proof that that money, Anti-Money Laundering Act again, came from a viable source of theirs, and then we can do a delayed purchase financing, and it's as if they had utilized the funds as a purchase. And they reimburse themselves essentially. They need to put the money back in their account, and they kind of made themselves more competitive in order to secure the home, but they've accomplished the financing at the same time.
Oh, that's great to hear.
And that concludes part 1 of At Home with Beach Realty with a question and answer session with Scott and Ryan. Stay tuned for part 2. Until then, thanks for joining us and take care.